Welcome to this Killick Explains video, and this week I want to take on something that's been worrying investors for months now, possibly, and that is why the current tech boom may not actually turn to bust. People with long memories will think back to the dot-com boom at the end of the 90s into the early noughties and wonder whether we're about to see a repeat, and I'm not sure we are. Let me explain why. So, what boom? Well, frankly, unless you've had your head under the duvet, you can't have missed it. The US stock market in particular is dominated by a small group of stocks known as the Magnificents. Don't need to name them all. They're huge. They represent, depending on how you cut it, at the time this video is being made, that's mid to 3/4 of the way through 2024, around a third of the S&P 500. And if you take one of them, Nvidia, all right, the semiconductor chip manufacturer, that's gone up around 5 times in just 2 years. Now, some people are looking at that and thinking it's too much, too quickly, too concentrated, all right? So is there a crash looming? I'm not sure. Corrections, yes. I mean, those loom for all kinds of stocks. Dips, yes. We're not going to rule that out. It'd be crazy. Volatility is part and parcel of investing. But a major dot-com style crash, possibly not. Why not? All right, well, number one, these are companies that all do real things. They've got products. They sell those products. They have strong customer bases. And here I'm thinking back to the end of the dot-com boom, where that honestly was often not the case. These are companies which are profitable. They haven't always been, but these are companies which are profitable. And what's more, in the main, they generate cash flow. They're able to turn profits into cash flow. All right, that's a fairly solid business model. They all have sustainable competitive advantages, wide moats, as Warren Buffett likes to call it. They're run in the main by experienced entrepreneurial management teams that are used to scaling businesses. And that latter point is quite important. And most of them are enjoying the benefits of first mover advantage. They're actually quite hard to imitate. No business is impossible to imitate, but they have a kind of good head start. All right. Now, let's turn to valuation. End of the dot-com boom, things got a little bit crazy. Valuations got crazy. Sexy technology stocks were valued on huge, ridiculous multiples. But what I would say is, although some of the conventional valuation metrics applied to the Magnificents, as I call them, can look a little bit punchy in some people's eyes, they are nonetheless based on stuff like profit, stuff like revenue. You know, you can do PE ratios, you can do price to cash flow, you can do price to revenue. At the end of the dot-com boom, you couldn't do any of that. These were companies back in the day that had no cash flow, had no profits. Some of them had no revenue. Some of them barely had a product. So they were valued on the things like, you know, price to eyeballs and price to clicks. Crazy valuation metrics. I'm not seeing evidence of that happening in this instance. Then we've got the stability argument. Yeah, the Magnificents are pretty stable companies. These are not companies that have just come out of the woodwork in the last year and a half. You know, there was a flurry at the end of the dot-com boom, the last one, of companies just appearing left, right and center. These are companies with solid, embedded, usable products. All right, their influence is pretty widespread. It ripples through all kinds of sectors. Their impact is probably going to be permanent. And of course, AI, the advent of AI adds another layer to the story. It's come in just to the point where some people were seeing a potential lull and could add quite a substantial tailwind to a number of these stories. But, okay, that all sounds great, but there is a but, and it's this. Number one, getting bigger gets progressively harder. That's a rule of thumb for all companies. You know, Apple has found out that continuously achieving growth rates in double digits year on year is tough. All right. Volatility is also inevitable. I mean, just look at Nvidia. It can swing by 15, 20% over very short time periods as people try and work out whether the story actually makes sense. So getting bigger, quicker, volatility, all part and parcel. Will there be a crash? Probably not. All right. But there are some rules, and I want to finish on these rules. All right. Do not pile into these as single stocks. That goes for any stock in the market. That would have gone for BP a while ago, Marks and Spencer. It certainly goes for these big tech stocks. Okay, make sure you take a long-term view. There is going to be volatility. All right, scaling these companies will get progressively harder. All right, so take a long-term view, be prepared for dips, sometimes quite sharp ones, and always be prepared to rebalance and rotate. What I mean by that is if these are such a big proportion of the S&P 500 and you're wedded to the S&P 500 index on a market capitalization basis, which I wouldn't necessarily recommend, by the way, then you are being dragged. More of your money is being dragged into these big tech stocks. You do need to look at that periodically and think, am I overexposed? Should I rebalance and or rotate? Okay, that's probably enough from me in this video. If you'd like to watch other videos, do go to killick.com/resources. If you'd like to read a bit more about stock valuation in particular, then my how-to guide on equities is sitting next to me. That is the same web address or editor at killick.com. And naturally, technology is a talking point in our quarterly magazine, Confidant. And again, same two places if you'd like a copy of that.